makers and market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manus Cranny in Dubai. Here's what's coming up on today's program. European stocks and US futures gain. Speculation is the Fed is close to the end of its tightening cycle after raising rates to the highest level in 22 years. The focus now shifts to the ECB. Investors price in another hike, but the economic data is looking weak. Will it be the last? We're live to Frankfurt. Plus, a bumper day for buybacks. Barclays, Total and Shell all plan to return cash to shareholders. We'll speak to the top executives this hour of Accor, Renault and Roche, all coming up in the next 60 minutes. The map is live, the prices are there, and this is what we've got for you. It was a bit like the Field of Dreams if you listened in to the Fed meeting last night. That was 1989. It was homage to American dreams. And here we are, a homage to the end of an ECB rate hiking cycle as we see prints of green all across the spectrum. Shell doing a buyback of $3 billion. Where will Barclays take you next as they warn that you are near the end of that nirvana, which is NII, net interest income, and the trading plummeted by 41%. Barclays doing a buyback. So you have buybacks everywhere from Total, Shell, and Barclays, all having various impacts across the map. But I want to take you to the position there. Shell down nearly 2% on the open. This is some of the concerns in the oil majors have about the outlook going forward. Now, if you want to understand the challenge for the ECB, and we'll catch up with Maria in just a moment, Barclays down 5.5% and change at this juncture. This is the lending situation. Robin Brooks on Twitter last night talked about the lending squeeze that there is. In the United States, there's a 2 standard deviation tightening, and in Europe, there's a 1 standard deviation tightening. It's picking up. Is it time to stop hiking with these kind of crunches in terms of credit standards tightening? It will transmit to the real economy. Let's have a quick look across the asset classes, because if you're a bond trader, you heard one narrative from Jay Powell last night was that we may go into pause land. However, JP Morgan think that you're going to have 9 months of a pause. What does that do to the short end of the curve? Do we stick at this kind of level? NYMEX is up by 0.8% as the survey at Bloomberg, 15 out of 22 say Saudi will extend its unilateral cuts, and also inventories draw down at Cushing. You have the dollar dropping. This was the barrier for the burrs has been removed to a certain extent, and so you are seeing the dollar down. Now, Turkey has just indicated where they are with end-of-year inflation. They estimate it to be 58%. 58%. We know they have a huge inflation issue in Turkey. There we go. But they are moving from unorthodox policy to more orthodox policy. From 22.3% is where they are. Dollar up, lira down, a smidge at the moment. Let's reflect on the Fed. Across the assets, this is what we've got for you as well. A little bit of movement in the wheat market. We're down. We had the biggest move down in 9 months yesterday. You're also seeing those 2-year yields move ever so slightly lower. Let's reflect on the Fed. It's done. 25 basis points. And the chair of the Fed, Jerome Powell, he left the door open to more increases and said they would be, guess what, data dependent.
We haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking.
Eddie van der Velde is with me from our Markets Live team. Now, I don't know whether I go as far as Seema Shah to say it was a yawn, but it was pretty, insipid forward guidance. Does that mean a job well done with maximum optionality, Eddie, or do you think it's an extended pause? Come back
Manus,
to me, Eddie.
yeah,
there you go.
Hello, Manus, can you hear me? Yeah, it was absolutely interesting. It was absolutely interesting. Right. I don't think there was anything like the panic, that we've all, the excitement that we've had in previous meetings. And, you look at pricing after the meeting, it's pretty much where we were before. And that's all fine, right? But during the meeting, there was a lot of moments of excitement. And you saw asset prices move a lot because the market was trying to make sense of not only what Powell is signaling, but what Powell is thinking, right? And I think we're going to hear a lot more of this data-dependent sort of line, because I think that, you know, the Fed genuinely does not know what it's going to do. The Powell doesn't know what to think about the future, because we are getting mixed signals about the economy. We are getting slowing growth. We are getting we are getting hot inflation or slowing inflation, but at the same time, we're not there yet, right? And the jobs market remains strong underlying. So I think there is a lot of questions still to answer for the Fed. And I think that's why Powell does not want to commit. And I think it does take some of the excitement out of the Fed meetings, because, you know, but at the same time, it leaves a lot of questions open for the future. So I think it has actually become a lot more of a healthy trading environment for traders who want to put on positions, betting on where the future path is.
Well, I suppose it depends which group of people you speak to. Eddie, thank you very much. Between the bond and the equity traders, Eddie van der Veld at our Markets Live team. Joining me now is Sfia Salim. She is head of European rates at strategy at Bank of America. So what goes through my mind as I reflect on the Fed, let's just start there, is that if you're a meat-eating bond trader, you heard pause. If you're a quiche-eating equity trader, you heard soft landing. What did you hear?
No, absolutely. I think that the market really needed to hear a lot more emphasis on potentially an additional rate hike coming for there to push additional increases in rates from here. But what we heard from Powell was actually very balanced. And in fact, the word balanced came up 13 times, while having come up just 9 times at the last meeting and 7 times at the previous one. So he had a lot of opportunities to actually push the market to pricing a little bit more hikes, or at least to price out some of the cuts implied in 2024. But he did not. In particular, he did not focus too much on the fact that financial conditions have been easing lately, and he did not focus either on this additional guidance that the dots were pointing to, which is an additional hike for the next meeting.
Well, I started the show talking about the tightening in credit conditions, and a big shout out to Robin Brooks at IIF here. He flagged it in terms of the standard deviation move, the scale of tightening in credit conditions in the United States and in Europe. When you look at the constriction of credit, does it suggest to you that now it is important to pause and reflect and let the long variable lag take hold in both the US and in Europe?
I think when we look at actually the lending surveys, we find exactly what central banks are expecting, which is that credit conditions are tightening as a result of all the tightening that has been delivered. We've had 400 basis points of rate hikes from the ECB just in the past year. So it makes sense for credit standards to be tight. Now, one thing on the ECB's bank lending survey that may have surprised a little bit the ECB and could point to the need for more caution here is the fact that demand is falling a lot faster than banks were expecting. I think it's really that point rather than the financial conditions or the actual credit standard themselves that come as a surprise.
Well, I suppose it's a question really of trying to tamp down inflation and demand without breaking the system. Stay with me. We're going to pivot to the ECB. We have that decision today. As you know, President Christine Lagarde is expected to follow in the Fed's policy footsteps, I should say, with a 25 basis point hike later today. Our European correspondent, Maria Tadeo, is outside the ECB in Frankfurt. Maria, the sun is not... Wow, you're inside now. They brought you in from the cold, Maria. That's always good. Talk to me. What are we expecting today in terms of the red? I know you caught me there. You caught me. Thought you were outside. 25 basis points, but how many times do you think she'll go with balance? Do you think she'll match and meet Mr. Powell? Good morning.
Look, it's always a balancing act. And Manis, nothing is official until she makes it official. But you know it, I know it. Probably anyone who owns a Bloomberg is ready for a 25 basis points hike today. Of course, two simple reasons behind it. A, she pre-announced it, repeated that message in Sintra. And then, of course, you had the core inflation print that came in for June at 5.5%. Obviously, you put it together, it takes you to that 25 basis points hike. But a lot of this, as you say, will be about the future, and it will be about September. And you've talked about it with your guests on the show. The trade-offs now between the economy and inflation obviously become more of a flashpoint. We've seen the PMIs. They're not good. This is still an economy that's not able to catch a breather. There's a perennial question about monetary policy and the lag of it. When do you know enough is enough? And you put all of this together, you could argue there is today an incentive for the European Central Bank to actually stay pretty neutral, to not signal a bias either way and revert to this very data dependent. We'll look at the data and we'll take it from that basis on. Of course, we also know that there will be projections that will come up in September too, and that's when the new decision should take place from the ECB. So there's a lot at stake when it comes to September, but I'll be also curious, particularly in the press conference, about the idea of rate cuts, because the worst case scenario, the nightmare scenario for the central bank would be to have inflation above target, and this chit-chat about rate cuts earlier than previously anticipated taking hold. Will she try to put an end to that debate? That I'm particularly curious about.
Okay, well, let's hope those nightmare scenarios don't come true. Maria, thank you very much. Have a good day inside the ECB. My guest is Sfia Salim, head of European Rate Strategy at Bank of America. You make it very clear that we'll have a little bit of a shuffling of angst at the short end of the curve, but the real action will come in the belly. So if I'm looking across the curve, the Bund, the bobble, and the Schatz, it's the bobble where you say, I'm going to see perhaps the most performance. In what way?
Yeah, absolutely. I think that when you look at pricing in the front end of the curve, it is actually implying a terminal rate just under 4% and a first rate cut by the ECB in the middle of 2024. We think the ECB might be comfortable with that. And if the market reads the press conference on the dovish side, if, for example, there is emphasis on the bank lending survey during the press conference and the market rallies, we believe that actually we will hear from those famous ECB sources post-meeting that try to correct any rally in the front end of the curve to specifically avoid the nightmare scenario that Maria was pointing to, the pricing of this rapid cuts. However, where the ECB may have less impact when pushing back against this repricing is in the belly of the curve, because investors now are still keen to put on those end of cycle trades, and it is likely to have the most impact on the 5-year point, we think.
Okay, Sfia, thank you so much for being with me. Let's see what the guidance is today from Madame Lagarde. Sfia Salim, head of European Rates Strategy at Bank of America. Coming up, the French hotel operator Accor upgrades its full-year forecast. We speak to the Deputy CEO, Jean-Jacques Morin. He joins me next, right here on Bloomberg. Welcome back. The shares in the hotel group Accor slightly lower this morning. This is the French company reported revenue just ahead of expectations in the first half. They upgraded the full-year forecast. Joining me now is Jean-Jacques Morin, the Deputy CEO of Accor. Jean-Jacques, good to have you with me. A very bullish call on the RevPAR. It'll be up 15 to 20%, and EBITDA also a strong guidance higher. Where are the strongest markets at the moment? Where's the biggest and most robust demand?
You know, the publication we went just through as being an additional quarter of, I would say, increased performance. Since 2021, every quarter is getting better, and Q2 is no different. Q2 is better than all the other quarters. And the short answer is that every segment and every region is doing extremely well. But the one with really leading in terms of the rebound in Q2 is Asia. You know that the recovery in Asia was lagging probably 12 months the recovery from the other region, and hence you find a very normal phenomenon by which now that Asia is reopened to travel and the COVID in China is behind us. I think you see naturally Asia leading the pack. But I must say, you take a region like Middle East and Africa, despite a gorgeous year last year, still continue to be extremely strong. So it's across all markets with Asia leading.
And when I caught up with Sebastian in Qatar at your new trophy assets there, it was pretty obvious that he just didn't have enough capacity to sell to the super rich, of which I'm not. Where are you on capacity? Do you have enough mid-tier capacity, upper-end capacity? Talk to me about the constraint and what you need.
Yeah, Sebastian obviously depicted a picture which has not fundamentally changed in a couple of weeks. We are probably 5% in terms of occupation rate behind the peak of 2019. But that situation is improving quarter after quarter. When I was talking to you about the improvement of the performance, really the first driver has been pricing. The driver today still remains pricing. Probably 2/3 of the improvement in the top line is coming from pricing, but 1/3 of it is coming from occupation rate getting better and better. And there are some elements to it, which is also the capability in our hotels to get the right level of staffing. So the hiring post the COVID crisis is now something which is getting normalized. So you will find out that the trajectory will improve quarter after quarter in terms of our capability to supply hotels, and this is what you see in the number. And this is also why, in fact, not only do we have quarter after quarter an improved performance, but as you mentioned, we are increasing our guidance for the year end, and we are talking of being somewhere between 15 to 20% in terms of RevPAR, but at the top of those 15 to 20%, okay, which is a very, very nice result.
We look at images every day in Greece of wildfires, evacuations, and newsreels are rolling. You have exposure in Athens, Corfu, Crete, and Rhodes. Are you seeing cancellations? Are you seeing any drop-off in bookings?
Not at all. Not at all. In fact, the demand today is amazingly strong. We are the first month into summer, and you're right, the situation is, in terms of the heat waves is quite difficult in many places. But I can tell you, this summer will be better than 2022, and 2022 summer was the best ever. So I think you will find out that summer will just be incredibly strong, and we don't see nothing of those effects into our numbers.
You are in exclusive talks with Potel and Chabot. Is that the strategy for you and Sebastian, which is major trophy assets rather than mid-market volume size?
No, it's not. I wouldn't say it like that. You're right that we are in discussion with Potel, and the Potel is very much part of the lifestyle strategy by which you want to provide experiences which are unique, and as part of providing those unique experiences, the Potel and Chabot, which for those of you who don't know, is about catering, is unique. I mean, they are the top in the French market, and hence, having them as part of our family, if you will, is making our offer even richer in what we call lifestyle, which is, as you may know, 50% based on food and beverage and 50% based on, I would say, the more classical business of offering rooms. But I think here the strategy as being the following: there is a core business, which is what we've done for 50 years, which we call premium, mid-scale, and economy, which is based on very iconic brands like Ibis and Pullman. And this one will continue to nurture. This is a very stable base. It generates cash. It generates profit. We've got a very strong foothold, and this is going to continue. And on top of that, we had a relay of growth, which is what people demand today, whether they are the high net worth individual or more largely, I would say, the middle class, which is growing year after year and getting richer and richer. And that market is being addressed by lifestyle.
Okay, well, I look forward to a wonderful lunch one day in Paris. Hopefully, with the team, we can assess that. My guest this morning, the Deputy CEO for Accor, Jean-Jacques Morin. Big energy, big results, big buybacks. Despite the drop in profits at Total, they are holding their nerve. They are delivering a $2 billion buyback in Q1 and Q2, despite their second quarter profit dropping by nearly 50% to just under $5 billion. So down an eighth of 1%, but the brutality came for Shell. They announced a buyback of $3 billion. But of course, this is a tough time. Quarterly income, $5.07 billion, down from $9.64. They're skimming off the top on CapEx. They're trimming $1 billion off CapEx to $23 to $26 billion. Coming up, the Roche delivers their profits. We talk to the CEO in a post-COVID world. European stocks and US futures gain on speculation. The Fed is close to the end of its tightening cycle after raising rates to the highest level in 22 years. Focus shifts to the ECB. Investors price in another hike. But the economic data is looking weak. Will it be the last? And a bumper day for buybacks. Barclays, Total Energy, and Shell, along with a few others, all plan to return cash to shareholders. Very good morning. Welcome to the Pulse. I'm Manus Cranny in Dubai. That rallying call, instead of drinks for all my friends, it's cash for all my friends in the form of buybacks. So we're in this eye of the reporting storm. And pharmaceutical is on the agenda. And Switzerland, Roche, the profits there fell just short of the estimates in the first half. That says new drug revenue at the Swiss pharmaceutical company failed to offset the disappearing market for COVID-19 tests and treatments. The CEO is Thomas Schinecker. He joins me now. Thomas, thank you for being with us. We're all conversant with COVID ending and that lump being taken out of your results. But you have had challenges in cancer and Alzheimer drug failure. What is the gravity of the situation for you? Is this your sort of low point for Roche? Good morning.
Thank you for the invitation. As you mentioned, in the first half of the year, we had really fantastic growth of our base business, meaning excluding COVID of 8%. We all knew the COVID pandemic would end, and that's why we also included that in the guidance. In fact, that's what we saw in the first half of the year. And this growth is really driven by a strong portfolio of new medicines. We've launched 20 new medicines since the end of 2015. And those are going to carry us into the future. And also on the diagnostic side, we've had very strong new launches of new innovative instruments and tests, and many more to come. With that, we're very confident that we'll continue to grow, especially after this period of where the COVID sales will wash out. This will be by end of Q1 of next year.
Do you think there is a disconnect, Thomas, between what you've just said to me and what the market believes? I look at your stock's performance, 400 Swiss francs last year, 271 is where we are at the moment. You're underperforming your market and your peers. The market does not seem to believe that you have the right combination of future drugs. What do you say to those people who think you lack the pipeline that you need to deliver blockbuster after blockbuster?
Well, first, we probably profited in the share price also from COVID. And as this washes out, the underlying performance will shine. We have these 20 new medicines that will continue to drive growth. And we have a number of very interesting new medicines in the pipeline. Tiragolumab in cancer, just to name one. Giredestrant in breast cancer. Fenebrutinib in multiple sclerosis. We've just done this deal with Alnylam on hypertension, which affects 1.2 billion people in the world, and 80% of them not being controlled. So we have a number of very interesting medicines. And again, this year, we launched 2 new medicines. So you see that our pipeline is performing. And I do believe that as we continue to deliver positive results, as we've done this year, throughout the year in the different trials, that this will also be reflected in the share price.
Okay, so you're asking for forgiveness and time?
I'm just saying that I think we have a great pipeline. We have great on-market portfolio. And once the COVID effect washes out, this will be seen. And we'll continue to deliver on our pipeline. And that will be then also reflected in the share price.
So with that ambition in mind, and that's a very clear message, and I get that, which is the pipeline is fine, it's firm, it will take a bit of time to deliver. Do you say, no, Manus, I don't need to go and buy any new pipeline, I'm organic all the way, or will you hold the option to buy pipeline?
It will always be a mix. It's been a mix in the past. We've always been looking also at external opportunities. I mean, we look at hundreds of companies every year, and we decline 99.9%. It has to make sense from a scientific perspective. It has to make sense from a financial perspective. And as you've seen with the deal that we made with Alnylam, we are open to medicines coming in from the outside. But we're looking at transformational, best in disease or first-in-class medicines. And this is one of those opportunities. And those are the things we're open to at the right price.
You have given some guidance today, low single-digit growth. Is that, again, I sort of reflect back, I want to benchmark where you are and where you're going to. Low single-digit growth for this year, but what would be your ambition going forward? Is that a low point in the guidance?
So we don't give out any guidance for the next years. What I can say is that, as you see it in the first half of the year, we already had washed out 2.7 billion Swiss francs of COVID effect. We guide for the full year that we'll have a 5 billion COVID effect. With that, 80 to 90% of our COVID sales will be washed out. So the last effect will be in Q1. And I do believe that the underlying performance will then be more visible.
I looked at your shareholder roster, BlackRock, Vanguard, Roche. You're very well insulated. You have some of the best people in the world on your roster. But are you receiving pressure from any of your institutional shareholders for something a bit more radical to happen at Roche?
In pharmaceuticals, you have to take also certain risks. And that means we have to invest into new medicines. And at the end, only 1 out of these 10 medicines makes it. And people that are investing into pharmaceutical stocks, they're all aware of that. And they know that you will have times where you will have failures. But at the end, as Roche, we have delivered 20 medicines over the last 15 years. We have a full pipeline, 81 potential NMEs. We are always also looking at external opportunities. So I'm confident that Roche will perform well into the future.
What do you fear the most? An activist investor coming on board or a bid? Are you always ready to defend Roche?
Look, for us, it's all about innovation. And that's the clear focus of myself and my team. We're continuously working on our pipeline, looking at how we can get more medicines that have first-in-class, best-in-disease potential, new transformative medicines into our pipeline. If you look at the 5 major growth drivers that we had in the first half of the year, you look at Vabysmo, the new eye medicine that this year will make more than 2 billion Swiss francs. Last year, we just launched it. It transformed standard of care. You look at Ocrevus, strong growth driver in multiple sclerosis, revised the standard of care. You look at Hemlibra, it changed the standard of care for people with hemophilia. So that's our goal, deliver transformative medicines. And that's what keeps me up at night, not because I'm concerned, but because we're working hard to continue to deliver those kinds of medicines.
As you look at that roster of new drugs, you said you're open to drugs only if it makes sense and only if it's transformational. Where is there a mini gap? Where is there, if you had your choice, Thomas, of an area to acquire, where would that be in drugs?
Well, I wouldn't want to comment exactly which areas we're looking at. I hope you understand that. But clearly, we look at transformational medicines.
Short and sweet. Broad church, transformational medicines. We wish you well. Let's hope we get back to the 400 Swiss francs from where we are today. Roche CEO Thomas Schinecker there joining me around the conversation. Coming up, another CEO conversation. This time, record margin, strong demand for the French car maker Renault says it will be facing problems with logistics. The CEO breaks them down for me. Luca De Meo in just a moment here on Bloomberg. The piece of banking delivered today, Barclays and BNP Paribas, and it's calling a peak of NIMs at Barclays. That has the market under pressure. The lender is cutting its guidance for the UK, and they say net interest margin to 3.1%. Total income, a 14% rise in the total income from a year ago. But they are warning here that things are beginning to top out. People are worried about the overall health of the economy there. Trading revenue down 41% from a year ago. That 1.75 billion. And of course, fixed income trading division, FIC. Those meat-eating bond traders, they'll not be eating too much meat tonight at Barclays. Fixed income trading down 22% at 1.2 billion. And the equity revenue fell 60%. Wow, 60% trashed in the equity trading division, down to 563 million. And of course, there was a serious error included that a year ago. So Barclays is down 4.3%. Paribas on the other side, however, storms away. Cost control, reassuring the street. You've got Morgan Stanley saying, look, strong set of results. The market did well. So a lot of the analysts are sort of saying the net income, 2.81 billion. That dropped by 9%. But the estimate out there was, so it's below the estimate, down 9.1% year on year. And the estimate was for 2.52. But I think really they're just focusing on the cost cuts there. The performances in costs were particularly impressive, according to KBW. And so they're rewarded, up 3.39%. A lot of job cuts have gone through. It's been a tough time across the banking sector, investment banking. Deals are not getting done in Europe. They are here in the Middle East. Come to Dubai. That is the narrative. Now, Bloomberg has learned that the advisors in the UK to the Chancellor, Jeremy Hunt, are increasingly concerned that the Bank of England risks raising interest rates too much in the coming months. Is that interference? I don't know. Let's ask Bloomberg reporter Philip Aldrich. Why should the advisors to the Chancellor have any concern at all about what an independent Bank of England is doing? Good morning.
Morning. Well, I suppose they are the sort of economic advisory council, so their remit is broad. I mean, there are a couple of members who are recent members of the Bank of England, and there's Andy Haldane, who was the chief economist until recently, who was sort of sounding the alarm on inflation quite early. And obviously, inflation is kind of the key issue. So, they are an independent committee themselves. The Bank of England is independent. I think it's perfectly reasonable for one group of independent people to comment on another group.
Absolutely. Well, I suppose the horse has bolted. I mean, we've had the fastest hiking cycle. I think I don't know whether it's in history, but it's certainly pretty brutal, isn't it? Can you foresee a time when the Chancellor and the PM become more openly critical of the Bank of England?
There was it's very unusual for the politicians to be openly critical of the Bank of England. Obviously since '97, there's been independence and separation of responsibilities, and the guidance, the principle has always been that the politicians will not comment on monetary policy, and the central bank officials are not supposed to comment on fiscal policy if it does stray. And there have been moments. So in 2007, there was a lot of tension behind the scenes between the governor at the time, Mervyn King, and the chancellor at the time, which was Gordon Brown. And it later came out that Gordon Brown had wanted to intervene in the bank publicly, but felt he couldn't because he didn't want to undermine the independence. of the Bank of England. So it's a pretty fraught thing for the government to actually go public with criticisms. Politicians are free to do that, and they have been doing that quite a lot. But for the executive branch of Parliament, for the government itself to do that would be unusual.
I mean, Phil, you've got a lot, as you say, of ex-BOE policymakers on this council. What would you say the consensus is in terms of the government's actions on inflation? I mean, the Bank of England's actions are blunt and big-headed, aren't they, in terms of interest rate hikes, and they have QT at their disposal as well. But what about the government impact on inflation?
Yeah, so the government's first responsibility and is on inflation is basically do no harm. It's tough line on public service wages. Public sector wages is an example of that. So they're saying we're not going to raise wages at sort of inflation levels, 8-10% as the public sector workers have been requesting. But they have just raised them 6%, which is definitely a bit higher than the 2% target. So that in that respect, they're not helping. There is a degree of public sector restraint in terms of just general public spending. So that is an effort again by the government to help restrain any inflationary impetus. And there are things they can specifically do, but they can raise taxes to take demand out of the economy. If they just want to mechanically change the level of inflation, they can do energy price caps. They can do sort of price caps on food, on essentials, for example, and subsidize retailers. But there's things they can do, but they will be politically unpopular.
Philip, yep, thank you very much. Well, they take a lot of action around the price caps, haven't they, and the energy crisis. Philip Aldrich there with the very latest on the Bank of England. Let's turn our attention to Renault. The first half earnings have topped, recently upgraded their expectations. The car maker says that operating margin at a group level is going to hit 7.6%. Now, the shares a little bit lighter this morning, with the company still facing some logistic troubles, headwinds following the aggressive price cuts from Tesla. Let's bring in the CEO, Luca De Meo. He joins me now. Luca, great to have you with me. I mean, a great performance, and you have record margin, strong car demand. It's almost Churchillian, isn't it? You've sort of never had it so good. Can the wave roll on? Good morning.
Good morning to you all. I think we are setting the condition for an improving performance in the next couple of 2-3 years. So far, we have delivered like 6 semesters in a row and always improving. So we are there to make it work. And one of the things that will change for sure the chances for us to improve is the fact that we will be launching 12 new models next year. So normally in the automotive business, when you have a fresh product, everything works. So we are pretty optimistic about the future, although we understand that environment is very challenging for a number of reasons, as you know better than me.
Well, we'll dig into those in a moment. So the new roster comes out next year. I want to square away a couple of things. The margin today, 7.6%. Can you hold solidly in the mid-sevens on margin?
Yeah, that's what the guidance we're giving for the end of the year. So we have, of course, now we are in July, so we have visibility. Normally, the H2 is always in Renault world better than the H1, but there's a lot of uncertainty into the market. We see on the positive side the kind of a deflationary movement on energy cost and raw material. So I think even if we see, of course, more pressure on pricing because volume are coming back and ability to produce, but on the other hand, we see the cost going down. So that's our commitment, is to improve on the performance that we have declared today, and which was, as you said, a historical performance for the group.
I mean, that is the dream scenario for you, isn't it? Which is you have a deflation on the cost and the input side, and you still manage to hike the prices to us. I want to talk about the order book, and I want you to take me inside the order book. It's 3.4 months at the moment, so you're above 2 for the rest of the year. I get that. I want to know where the strongest part of the order book is. I had Louis Vuitton on the other day, and they said there are cracks in aspirational luxury. At the upper end, where are as it were, the strongest part of that order book? Is it at the upper end? Let's just break it down for me.
Yeah, it is at the upper end. It is with cars, that we technically, let's say, consider the C-segment cars, so mid-size SUVs for us. In commercial vehicles, which is also a very good margin business for us. So this is how the place, how the orders are. And we expect with the renovation of the Clio in September to, of course, boost the absolute number in terms of order book. But in the meantime, we have to deliver a lot of cars which we couldn't deliver for many reasons and for logistic issues in the last couple of months. So, but it's a very healthy. We're selling cars at the higher end of the spectrum in terms of equipment. This was also part of our strategy is working. We have the majority of the cars that are selling the richest version. And that's the whole story of, volume to value and the Renaulution. So it's actually working. You can see it in the numbers.
I'm old enough to remember the original campaign for the Clio. I don't necessarily know that would fly these days, but that just gives you some idea about how vintage I am. Let's talk about something much more modern, which are your electric vehicles. Tesla are cutting prices. Is there pressure on you to cut prices? Are we going to have a price war in EV?
There will be pressure for sure. It was already the case, this year. What we did, in particular on the Megane, which was our precious product, was actually try to protect the value. So we didn't enter into this thing, accepting maybe a slightly lower volume that we had planned at the beginning. But then you can see the consequences of this into the residual value. So you look at the residual value of the Megane is actually growing, whilst the residual value of competitors is going down. And that's, for us, important, because then you set the right basis for the future business of EV that we will, develop with Ampere. That's our strategy, and we're not going to deviate from that.
You really prepared to give up market share?
Yeah, we did. We did in general in the last 3 years. We're making more money now than when we used to sell the double of the cars. So maybe there was something wrong in that old model.
Well, let's just talk about alliances. Nissan, they're chipping in 600 million euros, I understand, for a 15% stake in Ampere. Is that a cherry bite? Are you going to grow that alliance? Are they going to take a chunk? Are they going to go from a bite to a chunk?
So I have to correct you. It's not 600 million for 15%, because we haven't declared the share of this. It's a chip of 600 million, which is a substantial amount of money. The most important thing is that we have secured, in the deal that Nissan will have a board seat in Ampere, which I think is important for us, also to create stronger relationship with our partner. So they will be part of the governance of Ampere. And one of the things that you shouldn't forget is that, in fact, Nissan is, of course, taking a share of it as an anchor strategic investor, but is also, has also decided to produce cars on our platforms, on our plants in the Ampere perimeter. Okay. So there is an upside also in the margin that Ampere will do because of the production of Nissan cars within the Ampere perimeter.
A little bit earlier, you said Mitsubishi would buy. Okay, and they will have a board seat.
I think so. I think so. I mean, we have to follow. We have to follow the, let's say, the internal Mitsubishi governance process, but the intention is there to do the same. And so we will, of course, be very happy to welcome Mitsubishi people into Ampere.
So you said that they would buy products. So are they ready to contribute, to take 600 million for Nissan? Mitsubishi, would you expect them to do the same?
You gotta ask to them, So I think that I know that they would be ready. They find the Ampere initiative and project very interesting, especially to secure their survival in a way in the European market that will turn to EV very, very soon. And we have also ideas on how to serve Mitsubishi also in terms of production of models within Ampere. We have space, and we'll try to do business with them if it makes sense for them. But the question has to be asked to Kato-san and his colleagues.
Are we still in full buying mode? I look at bank lending in Germany collapsing. Credit conditions are tightening. We've had an energy crisis. Is buying a beautiful new car still top of my priority? You know, are there any cracks at all in the consumer or indeed in the commercial landscape?
Look, I think on one end you can look at the market dynamic. We see that in terms of orders, the market never recovered to the historical level. So we are probably 20-25%, depending on the market, below what we have experienced the last decade. So it's already a fact that there is an issue there. On the other hand, we also have to say that the market has been low for years, and for many years, at a certain point in time, people will have to renovate the fleet and their cars. Okay. So, and if we are able to, offer products that are attractive, and then of course we can take advantage of it and we can take market share. One of the, let's say, chances that Renault has.
We're going to have to leave it there. Yes. We wish you well on taking more market share. The Renault CEO, Luca De Meo, my guest this morning, right here on Bloomberg.